Main Street stock, ticker symbol MAIN. This is one of the most popular monthly dividend paying stocks, and with reason. Dividend yield is at 7.8%, which is quite high of course, but also very interesting. Main stock is down 24% year to date, which is similar to the overall market. The S&P 500 is down 25%. But does this mean that Main Street stock is a buy? In this video I'm going to show you real quickly what Main Street Capital does, the historical returns, the fundamental analysis, dividends, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does Main Street Capital do? Main Street Capital Corporation is an investment firm engaged in providing customized debt and equity financing to lower middle market companies and debt to capital middle market companies. The investment portfolio of the company is typically made to support management buyouts, recapitalizations, growth, financings, refinancing, and acquisition of companies. The majority of the income comes from fees, commission, and interest. One of the first things they talk about in the investor presentation are the dividends. Consistent cash dividend yield and paying monthly dividends. Main Street has never decreased its monthly dividend and has a 100% dividend increase since 2007. So they have seen the 2008 financial crisis and also the pandemic in 2020, but still managed to increase dividends, which is pretty impressive. If we check the portfolio breakdown, we see a few interesting things. First of all, the investment portfolio. LMM represents 49%, private loan 35%, middle market 10%, and other investments represents 6%. The average investment size is 17.2 million, and the largest individual company represents only 2.8%, and most investments are less than 1%. The weighted average effective yield is at 9.4%, so they are well diversified. In this graph we see the industry diversification. Internet software and services is the biggest industry together with machinery. Each industry represents 8%. In this graph we see the financial performance for Main Street. After 2020 we see an increase in year-over-year growth of 30% in 2021 and 27% increase in 2022 year to date. So this 27% in 2022 is still pretty good. On top of that, the distributable net investment income, also called the DNII, is growing at 29% in 2022 year to date. In this graph we see the DNII over a longer period of time. In 2019 there's a decline and in 2020 there's also a decline. But this one is related to the pandemic. And in 2021 and 2022 things are growing again in high amounts. And now that we know more about Main Street, it's time to check the historical stock price to see what happened there. I decided to include the S&P 500 as the benchmark, since this is one of the easiest ways to invest. Just buy an S&P 500 ETF and wait. Next to that, I also added ARS Capital, ticker symbol ARCC, and Gladstone Investments, ticker symbol GAIN. On the 5-year chart we see that Main stock had a 27% return including dividends, which isn't a lot to be honest. After the big drop in 2020 it didn't perform as good as the others in this list, and also underperformed the S&P 500. The S&P 500 had a 55% return including dividends on the 5-year chart, while ARCC and GAIN both outperformed the S&P 500 big time. On the 1-year chart we see that Main stock had a minus 12% return, while the S&P 500 had a minus 15% return. ARCC and GAIN did a better job at minus 9% and minus 6%. On the 6-month chart we see a minus 17% for Main stock, while the S&P 500 returned a minus 21%. ARCC had a minus 15% return and GAIN a minus 22% return. So only Main stock and ARCC did a better job than the S&P 500. On the 1-month chart we see that Main had a minus 18% return. The S&P 500 a minus 9.9% return, ARCC minus 12% and GAIN minus 15%. So Main stock didn't perform very good in the last month. And does the decline in stock price mean that Main Street Capital stock could be a buy? Let's check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe and in return you receive similar analysis to this one every week. Let's continue by diving into the fundamentals. Main Street is a 2.47 billion market cap company with a PE ratio of 9.5, which could indicate that they are undervalued. Later in this video I will show you my 3 price targets for Main Street, to see at what price I want to buy Main Street stock. Next up is revenue. Main Street has a trailing 12-month revenue of 359 million. And in this graph we see that the revenue is going up quite nice and steady, except for the lockdown periods, which isn't a big problem to me. Net income is at 285 million, which gives us a profit margin of 71.9%, which is below the 5-year average of 74%. So definitely keep an eye on that number, since margins are decreasing a bit. Main Street has 1.86 billion in debt and only 40 million in cash. Operating cash flow is at minus 446 million, leverage free cash flow is at 140 million. So they can't pay down a big chunk of the total debt. So to be honest, I don't like this ratio a lot. I prefer companies who have more cash on hand. And the free cash flow isn't growing either, so this is also something that I really don't like. To me, it's very important that free cash flow is growing, since this is used to pay down debt, buy back shares, do acquisitions, pay dividends and all other things. So definitely keep an eye on this number. But now the good part, the dividends. The dividend yield is at 7.85%, which is pretty high. Annual payout is at $2.64 a share, and they pay you a monthly dividend of $0.22. And this is one of the reasons why people love Main Street. You receive dividends every month. Payout ratio is at 86%, which seems a bit high. But this is very typical for these kinds of companies, so I don't worry that much. I prefer companies with 85% or lower, so they are almost there. The 5-year growth rate is at 2.93%, which is very low of course. But with the dividend yield sitting at 7.85 already, I think this looks pretty good. They grew the dividends for 1 year in a row. Overall a pretty decent dividend scorecard, but does this mean to buy Main Street stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. I expect things to slow down a bit, since the pre-pandemic growth was also very low, and we see that growth starts to slow down right now. So I fill in 2% for the low assumption, 4% for the mid assumption and 6% for the high assumption. Profit margin starts to decrease as well, so I fill in 70, 73 and 76%. Free cash flow margin is negative right now, so I fill in 0%. PE ratio is at 9.5 right now, and I don't want to overpay for a slow growing company that underperformed the market average for the past 5 years. So I'm filling in 10, 11 and 12. Same story with the price to free cash flow. My desired annual return is 15%, since I can get an easy 10% average annual return with owning an ETF. Usually I fill in 12.5% for my annual return, but I want to build a higher margin of safety here with this company. Right now the stock price is at $34 a share. I hit analyze and we see a few green numbers. For now I'm focusing on the multiple of earnings value, so we have a low price target of 29, a mid price target of 35 and a high price target of $44. Since free cash flow is negative and the free cash flow margin as well, I'm not focusing on the discounted cash flow value. But this shouldn't mean that you should ignore it. So if you believe the mid or high numbers, then Main Street stock could be a buy. But remember to do more research on this company. To me, the low to mid price targets seems the most justified here. So that would mean a range of $29 to $35. And to be honest, I'm leaning a bit more to the low side. My final conclusion on this stock is that it's very interesting to have a monthly dividend paying stock. Dividend yield is very high at 7.8%. But other than that, the stock didn't perform very well versus the market average. So it all comes down to what your strategy is. Personally, I think there are better deals out there, and right now I'm skipping this stock. To me, Stack and Realty Income seem to be more attractive right now if you want to have a monthly dividend paying stock. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.